All right, now we are going to be talking about risk management, right? Now, we have risk management in trading, right? That's what helps you or sustain your capital, all right? For instance, okay, risk management strategies to minimize potential losses in trading. Potential losses in trading, right? This is something that helps you minimize potential losses in trading, like cutting your losses short. All right. So position sizing determine the size of a trade based on account size and risk tolerance. A common guidance is risking no more than 1 is to 2% of 1 to 2% of your account on a single trade. All right. It is advisable to risk one to make two. For instance, risking $1 to make $2. Stop loss order essential for limiting losses placed at a price level that triggers an exit for the trade. Stop loss is used to, for instance, you're on a trade, you need to set your stop loss at a particular area which you know that if price goes against you and go to that area, you know your setup is invalidated and the market should the trade should exit automatically, right? So the trade should exit automatically. Same with take profit. You should set your take profit at a particular place which if the market reach, the trade should exit automatically. So stop loss is cutting your losses short, right? But it's going to stop you out in a negative balance, while take profit is going to stop you out in the positive balance. That's just the difference between stop loss and take profit, right? Risk to reward ratio. Evaluating the potential reward of a trade compared to its risks. A ratio of 1:3 means it means risking $1 to potentially gain $3. So if you're risking $1 to gain $3, that's risk to reward ratio. That's what it means by risk to reward. Your risk is $1, your reward is $3, right? So we have ways of calculating or knowing the kind of lot size to use when trading. For instance, you want to place a trade. For instance, you want to place a trade now. You have to you have to know your stop loss. Once you know your stop loss, but you don't know this lot size you're going to be using. So I'm going to just show you how to calculate that right now. All right, I'm just showing you how to calculate that. Let's see. So right now, take for instance, probably you want to buy from this point right here now, and you're risking these amounts. All right, let me just use some other pair USD card. All right, let me use for instance, you're selling USD card, you're putting your stop loss right here, and you're targeting 2R, which is 2, risking 1 to make 2, right? All right, now this is your stop loss. This is your stop loss. Your stop loss is 24, I think, okay, 34 pips, right? This is how to know your pips. Once you look above here, you see the pips here, the figure right here. All right, so that's how you know how much the stop loss you are risking on a particular trade. Your stop loss is 34 pips. How do you calculate your stop loss? I have two methods, right? One of them is simple. In fact, the both are simple, right? But one is my own way of calculating it quickly, and the other one is some other way most people use, right? It's a popular site most people use to calculate their risk. All right, so I'm just gonna show you how to calculate that quickly. The site is not loading up. Before the site comes up, I'm just going to show you how you can calculate this, right? All right, here is my calculator. This is my own way of calculating uh, to know the lot size I'm going to use if I want to place trade, right? So let's take for instance I'm having $1,000 and I'm willing to risk 1% of $1,000. 1% of $1,000 is $10, right? So I'm willing to risk $10. How do I know it's $10? All right, this is $1,000. $1,000 times 1%. As you can see, it's $10. So $1,000, 1% of $1,000 is $10, right? So I'm willing to risk $10 on this trade. So right now my stop loss is 34 pips, right? And I'm willing to risk $10. What I'm going to do right now is the amount I'm willing to risk, and I impute it here, $10 divide by my stop loss, which is 34 pips, right? 34 pips divided by 10. This 10 is just constant. It's just a constant figure, right? Divide by 10. And once you click equal to, it's going to give you the lot size you're going to use, which is 0.02. So once you want to place your trade, you just go to your MT5. You just go to your MT5 or MT4 to place your trade. I'm just going to show you that right now to place your trade, alright? So as you can see, that's the lot size you're going to use. I'm still trying to load this page up, but it's not loading right now. It's not loading. I think probably I might just use my phone. If it does not come up, I'm going to use another site. We have two different sites. One is the babypips.com position size calculator, and the other site is my FS book, right? So I think I'm just gonna use the other site to I'm just going to use the other site to do that. Alright, so I'm gonna be using this I'm going to be using my phone right now to show you. Okay, so let me just quickly go into the calculator. Alright, this is the calculator right here, as you can see. That's it. So let me do this. So like we said, the pips is 34 pips, right? 34 pips. 34 pips. Let's see. What's the pair? Now you select the pair. As you can see, you come here, you try to select the pair you want to trade. You want to calculate the risk on, which is USD card. As you can see it right here, it's USD CAD. Alright. So now I just selected that right here. after selecting the pair, your currency, the currency you're using in the account is USD, right? You select your USD right there. Now the account size, which I said is $1,000, right? Now you put in $1,000. Once you put in $1,000, your stop loss in pips, which is this one, right? This is your stop loss in pips, 34 pips, right? That's 34 pips. So you put in 34 pips. The risk, what you're willing to risk, which is 1%, right? 1% you're willing to risk. So right now you can click on calculate down here. I'm just going to click on calculate. Once I click on calculate, you get your result right here. As you can see, you see the sizing right down here is 0.01. You can see it's 0.01. That's the lot size you are going to use. It's kind of different. Why? Because as you can see, mine right here, my own method is 0.02. 0.02. Yeah, mine is not that perfect, but at least I think it's gonna still give you almost the same thing. There's no more difference, just 0.01 difference, right? So as you can see, that's the two way I use to calculate the lot size to use on a particular trade. But this for the one that's easy for me is using my own method with the calculator, right? That's what I do use. Okay, so that's that for that on how to calculate the uh, lot size you're going to use, right? So let's go over to trading psychology. Trading psychology, right? Emotional control. Trading psychology involves emotional control. Alright, so emotional control, understanding how emotion can impact trading decisions and their importance of maintaining discipline. Common psychological traps: fear of missing out, which is FOMO, leading to impulsive trading. Those are the things that can affect you emotionally while trading, right? So overconfidence can result in taking excessive trade. All right. So what's FOMO? What's fear of missing out? For instance, you're about to take a trade, and that trade, right? Let's say this is my support right here. This is my support right here, and you're waiting for price to come down to this level, this support level, right? Waiting for price to come down to that support level. Once price come down to this support level, you are going to buy. That's what you are initially waiting for. But right now, price came down to this area. Price came down to this area, to this point. It didn't actually come back into your zone, right? It just came back here and started to reverse, right? And started showing signs of reversal. Now, what you now do is you now quickly go in on a trade from that area. You now quickly go into the trade, like place a buy trade right from here. You now quickly place a trade from this point. While initially you were supposed to wait for price to come back to this zone. So now, after taking this trade from this place, from this point, after taking this trade from this point right here, now price decided to do something like this. Let me show you. So now price came down here, Now, price decided to do something like this and come back to this area you were anticipating to go long initially, and now price came to your area and started to reverse just as you were anticipating. You see, what caused that? That was fear of missing out. You are afraid that you are going to miss this trade. It's already reversing to your direction, so you don't want to miss the trade. That's why you went in on this trade which you are not supposed to. So you need to master your psychology to know when to enter a trade and when not to enter a trade based on your strategy. You don't need to rush the things. You don't need to rush and jump into a trade which will lead to loss. Also, um, um, overconfidence can lead to excessive loss, right? Overconfidence can lead to excessive losses or risks, right? So having confidence that this particular trade is going to play out, that yeah, it's going to play, you're very confident, can lead to over risking. You maybe you are supposed to risk $1 on a particular trade, right? But because you are overconfident that yes, it's going to play out, you are too sure that it's going to play out, then you decided to go in all risking all your capital just because you might have a better reward, which is not good. That would lead to excess risks, and you might just lose your capital in the process because you just over risked everything. So it's not good. Those are the things that affect the trading psychology. So these are the things you have to learn yourself. Nobody's going to teach you. This is the main part of trading, the trading psychology. Every other aspect of trading, which is the technical aspect, analysis, and every the stop loss and all the stuff you're doing on the chart, at the technical aspect, are the very simple part of trading. Why? This part of trading, called this trading psychology, the psychology part, is the most difficult part, which even professional traders, some are still having to face that this part, right? They are still having to try to master this part, right? Even me myself, right? So this is the most important part which you need to take note of, and try to observe, like try to take note of this I'm telling you right now and the things I'm going to tell you now, so that you can learn from here and try not to do some mistake, right, which we have done in the past, right, or which we are still doing. And once you have started doing all those things, it's going to be difficult for you to change, because it's something that is kind of it becomes an habit, right? And for you to stop habit is something else. So like I say, fear of missing out, overconfidence, and all those stuffs are things to avoid while trading, right? So things you have to do, you have to develop a trading plan, right? Develop a trading plan, having a journal, trading journal, right? While trading journal is important for you to record your trades and know the things you are doing and the things you're doing, and try to learn from your mistakes. That's why the trading journal is very important, right? And creating a trading plan. Component of a trading plan involves trading goal, define what your aim to achieve, monthly profit or monthly profit or targets, right? Monthly profit targets, right? Sorry, I mean to say monthly profit targets, right? That's probably your goal. You are wanting to achieve a particular amount in this month, right? Then market analysis approach. Choose between technical, fundamental, or combination of both. your risk management strategy, outline how much capital to risk per trade and the criteria for position sizing, evaluation process, regularly assess and okay, it's just like you documenting every of your trades, right? So those are the things that you need to have in your trading. You need to have in your trading plan. I think I have a trading plan. I think I have some trading plan. Let me just show you an example. It might not be complete, but I'll just show you example of what I mean by trading plan. All right, I just have to show you. So let's see. It's actually on my phone, so I'm just gonna show you quickly on my phone. All right, here it is. Right, as you can see, this trading plan. Right, as you can see, my trading plan is having risk management and the technical part of it, which is point of interest, framework, entries, and other stuff. Right. The only thing that is not here is the targets, like monthly targets, which is not also kind of, but that can help you also, but it's not necessary. You mustn't have that, but if you decide to put that, well, it's up to you though. So as you can see, risk management, 1%, 1% capital, right? 1% capital per trade. Move SL to break even at 1 is to 2R, right? As if I'm about to trade, I'm going to be risking only 1% of my capital. And once I'm in that trade and the trade has moved into profit about 2 times my risk, I'm going to move my SL to break even. All right. What is break even? Break even is taking your stop loss from that entry point to from that your stop loss area to the entry point. That's break even, right? Then the point of interest, which is POI, which are the point of interest I'm looking on the chart. This is just a old trading plan, so I'm looking at major highs and low, order block, and the imbalance, right? Then the framework on the 1 hour time frame, gauge overall bias and locate major POI. When price enters a POI, drop down to a 5 minute time frame. Wait patiently for price to purge liquidity with the POI. Within the POI, wait for price to impulsively break structure and create imbalance. Enter at the OB responsible for break of structure. That's just the conditions to be met before entering a trade. That's the strategy, right? So if I didn't see all these conditions, I'm not going to what is it called? I'm not going to check mark them, right? As you can see, this box is just like something I have to check mark, right? Mark them like this. As you can see, I'm marking them. For instance, once my conditions are met, that's how I'm going to mark them. All right. Then as you can see, this is the entries. As the entries, the the OB cost, the OB that caused the BOS, which is the break of structure, the other block that caused the break of structure, the other block is the discount zone, the other block created clear imbalance. Okay, it's just like asking the question, okay, the OB that caused the break of structure, that's where I'm going to be taking my entry from. Did the OB did the OB is the OB in a discount zone? Is the other block in a discount zone? If yes, you just mark it, right? Is the other block created? Did the other block create a clear imbalance? If yes, you just check mark it. So that's it. Once your criteria are met, then you can go in on a trade. And before having a strategy like this, you must have backtest that strategy and see how that strategy works, right? You already know the information about that strategy, details about the strategy, the win rate of that strategy, right? So that's how the trading plan looks like. All right. So right now, um, we just finished the trading plan. All right. Now, practical trading strategy and implementation. Developing a trading strategy. Types of trading strategy: scalping. We have different types of trading strategy, right? You can go on YouTube and search forex trading strategy. So the strategy you're going to be using depends on the type of trader you are. Okay, so we have three types of rather different types of trader. We have the scalpers, we have the swing traders, we have the day traders, we also have the position traders, which the scalpers, they involves making multiple trades throughout the day to profit from small price changes, right? Requires quick decision making and execution, right? So a trader might enter a position for a few pips, then close it quickly to lock in profits. That's scalpers for you. They take a trade quickly and exit that trade quickly just for few pips, right? And close their profit, right? That's scalpers for you. They close their trade within minutes, right? Uh, Within an hour, right? Why day traders involve holding trades open within the same day, right? Not more than a day. They don't hold trade overnight. They don't hold trades overnight. They hold trades within that particular day they open that particular trade, right? So the swing trader involves holding position for several days or weeks to profit from expected price movement, right? They hold trades within days, weeks, more than 4 days, even more than a week, right? For 2 weeks, 3 weeks, right? That's swing traders for you. And why we have position trading, right? Which are the position traders? They trade long term trading, right? They hold trades for even months, even a year, right? Years, right? They hold trade for longer. They can hold trade that long for a year, right? Those are position traders. Okay, those are position traders. All right. So for you to have a strategy, it depends on the kind of trader you are. So if you are the kind of trader that have patience, you can be a swing trader. But if you don't have patience and other stuff, you can just look for a day trading strategy. And it still depends on your schedule. For instance, those of you that is in school, probably you might not have time. You can still be a swing trader, which you just place your trade and hold for days or weeks, right? You don't have to come to be checking at your looking at your chart all the time. But you see day trader or scalpers, they always look at the chart to see what the market is doing, just to find trading opportunity, or if they are in a trade, just to make sure they are monitoring their trade, right? If their trade is going well or not. So just depending on the kind of person you are, that's the kind of trader you're gonna be. Okay. All right. So right now, uh, that will be that, right? So what next is you developing a strategy. You can go on YouTube and search for a strategy and try to learn that strategy well. And you have a demo account. Like I said, I would advise you open a demo account if you cannot fund. Why? If you fund your account, you can go and use, like I said, fund a cent account. That's good for learners, for beginners to learn, to help you with your psychology, right, and emotions. So you fund your accounts, go on a demo if you don't have a live account, and start testing out your strategy, right? Start testing out your strategy. All right. Use proper risk management, risking 1 to 2%. That's the normal way of trading. Okay. Use proper risk management, test your strategy and see, right? It's recommended to test your strategy for 3 to 6 months, right? And see how well that strategy performs on in the market. Okay. You should test your strategy out before going to a real live account, right? Before funding a real USD account, you should test your strategy for at least 6 months. Yeah, at least 6 months. 3 to 6 months, but at least 6 months. Then after that, once you know the risks, the how your strategy works, the win rate of your strategy, you can now go into live markets, right? Reviewing and adjusting your strategy. That's why you need a journal, right? You need a journal to document or journal your trades so that you can review and adjust your strategy performance, right? You can review and adjust your strategy performance. All right. So that will be that for that. And yeah, I'm going to be ending the class right now. Right. This come to the end of our sections. Okay. So guys, you guys should prepare for the upcoming test, which is gonna be um after our interacting session on Thursday. I'm going to be dropping the test on Friday. All right. So guys, stay tuned and see you next tomorrow. Peace.